Welcome to our webinar on integrated reporting. My name is Raymond and I'm going to be your facilitator in this session. What we will cover today will address the concept of corporate social responsibility, the basis of integrated reporting and its linkage back into integrated thinking. We'll also address how organizations manage their capital, so the source and flow of their capitals. We will have a look at the linkage that exists between integrated reporting and the concept of good corporate governance. We'll look back at sustainability reporting and look at how that links into integrated reporting as it currently exists. And lastly, we'll look at the principles for defining what goes into an integrated report. As a starting point, let's look at corporate responsibility, sustainability, and the accountability that goes with it. To give you a sense of what we're talking about, I'm going to give you a quote that comes out of the World Commission on Environment and Development from way back in 1987 in their publication Our Common Future. And in that publication they define sustainable development as development that meets the needs of the present without compromising the needs of future generations. Now, we've come a long way since those days back in 1987 when this was put together, in that the way that companies approach their reporting, the way that companies approach their interaction with their stakeholders has changed quite dramatically. And in changing quite dramatically, what drives it in a lot of instances is the requirement to achieve an organization's responsibility, to discharge an organization's social responsibility. So every single organization has got an obligation, and this is effectively where we're going with this. So if you look at the definition of corporate social responsibility, it is how a business contributes to the achievement of sustainable development. If I take you to another quotation, coming out of the European Commission this time around, specifically around corporate social responsibility. CSR is a concept whereby companies integrate social and environmental concerns in their business operations and in their interactions with their stakeholders on a voluntary basis. There's nothing out there that says that organizations should do what they do or should hold themselves out to be accountable citizens. But they tend to do this out of their own volition in order to try and demonstrate to their stakeholders that they do care about the stakeholders and the environment in which they operate, and they're also trying to demonstrate to build up their own reputation. Ultimately, when all is said and done, if an organization has only one thing left, it'll probably be its reputation. So therefore, taking responsibility on matters, things that are going on around an organization, is one way that an organization can demonstrate that it is a responsible corporate citizen. This then leads us into the sort of information that companies currently provide in their reporting. If I take you back 20, 30 years, back in the 80s, 75% of a company's true market value was deemed to sit in its financial statements. Now, with the growth of, with the information age that we're faced with, the growth of the internet, the amount of information that is available out there on what companies do and why companies exist, the consensus is that the true value of a company is sitting out there in all this other information that is available to us. It's no longer in a set of financial statements. Now this led to the conceptualization of what has now become known as the Innovest Iceberg. And the thinking behind the Innovest Iceberg is pretty straightforward. Let's have a look at this next slide to demonstrate what I mean. When one sees an iceberg from above the surface, it is quite daunting in itself, in its size, in its mass, what we can see of the mass of the iceberg. But the true danger in the iceberg, or about the iceberg, is not in what we can see above the surface. It is what is below the surface that we don't see that effectively will sink the ship. So, bringing this back to corporate reporting, we're saying, well, what you see at the top, above the surface, that's effectively what is published in a set of financial statements. What you don't see beneath the surface is what makes the organization tick. So, in looking at the Innovest Iceberg, we're saying the Innovest Iceberg balance sheet effectively explains the remaining 75-80% of what makes up an organization's value. And there'll be factors that are based on environment, that are based on the human capital that an organization has at its disposal, the stakeholder capital, the involvement that the shareholders and other parties that are interested, have got an interest in the organization, contribute to the organization, its strategic governance. All these things come into play in determining what the true value of an organization is. If you're to look at it differently, as a 25-30-year-old person who's looking to put their money into an investment for their retirement, what is it that you would currently consider that would sway your decision in terms of which way you're going to go, what investment you're going to make? A lot of the information on which we would base our decision making at this point in time is not about how well or how bad, how much profit a company makes in a particular period. There are a lot more softer issues that are also taken into consideration. Hence, the consideration of environment, human capital, stakeholder capital, strategic governance around an organization. In looking at the iceberg balance sheet that the Innovest Innovest put together, they basically considered that stakeholder capital would take into consideration input from regulators and policymakers, would take into consideration the local community, any non-governmental organizations that an organization would be involved with, customer relationships, strategic partnerships that might have been established between organizations. So those sort of things will be considered. From a strategic governance point of view, looking at the board, looking at management of the organization, do they have the capacity to be able to take this organization forward? Are they adept at the changes that are occurring in the environment around them, and will they have the ability, the agility to be able to adapt to whatever the situation is in order to continue moving this ship forward? And to what extent is the organization adopting international best practice in managing the organization? From a human capital point of view, what are the labor relations like between the company and its employees? What are the organization's recruitment and retention strategies for its staff? Does the organization have programs in place that are aimed at motivating staff, aimed at retaining staff? All of that will come into play. And the one big thing that you'll find that is most important when it comes to human capital, the innovative capacity in amongst the staff that are employed by the organization. We live in a world at this point in time where there's so many changes that are happening at any point, that an organization must be in a position where it is able to adapt, it is able to innovate, and it is able to keep ahead of the curve. Health and safety issues come into play as well. It's not just in the mining space. I guess with any organization at this point in time, are the health and safety rules that an organization needs to abide by, are those being met? You look at the environment. What is being done in order to grow an organization's market share? What is being done by an organization in order to make sure that it's as efficient as possible? And it's the amount of pollution, if there's any pollution that is coming, that emanates out of its operations, that is cut back. Is the organization in a position where it can build customer loyalty? Innovation comes into it again. That in order to try and make sure that an organization maintains its client base, maintains its market, maintains its brand equity, is it seen to be at the cutting edge? Is it seen to be doing something about making sure that if it's pollution that it's causing, that it's polluting less, or it's cutting back the pollution levels to a point that is acceptable in society? All of this leads us into the definition of what accountability is all about. In defining accountability, we're saying it is the acknowledgement, the assumption of responsibility by an organization, and the fact that an organization can be transparent about the impact that its policies have got on its operations, on its publics, the decisions that it's taking, the actions that it takes, the products that it produces. All of these things will have an impact on how well an organization performs, on how it affects the people around it. So we're saying accountability effectively obliges an organization to involve its stakeholders in identifying, understanding, and responding to issues around sustainability within this organization. And where concerns are picked up, that those concerns are addressed. And in addressing these concerns, the organization must also be in a position where it will report back to those very stakeholders that it is identified, to say, look, this is the position that we find ourselves in. These are the decisions that we've taken in response to the concerns that you raised, and this is how we're going to move the organization forward. Then that way, that brand equity that we were talking about earlier, the customer loyalty that we were talking about earlier, is then built up, and is built up over a period of time. It includes the way that an organization governs, how it sets its strategy, and how it manages its performance. So all in all, to take it back to where we've been, is that while in the past, how well an organization performed might have been premised on its profitability, this is now changing, in that an organization might choose to sacrifice profitability in the short term in order to build its brand equity in the long term. So what does all of this mean then? An accountable organization will establish a strategy that is based on a comprehensive and balanced understanding of the issues that it faces. And here we're not just talking any issues, the material issues that it faces. It has been speaking to its stakeholders, it's understood their issues, their concerns, and it's addressing those things. Such an organization must also establish goals and standards against which its own strategy is going to be based, can be measured. Its performance will also need to be managed and judged in some context. So all of these things must come together. this organization must also be in a position where it is ready to disclose to those stakeholders that it has identified how it is performing, what strategy it has put in place, what goals it has set for itself, and how its performance matches up against that strategy, against those goals, those standards that have been put in place. All of this leads us to corporate social responsibility, and what we're going to do as a starting point is have a look to see what it is that drives corporate social responsibility. Corporate social responsibility in itself has become a business opportunity. The primary reason why an organization exists is to create value. Now, let's not misunderstand each other when it comes to what we mean by the creation of value. Value was viewed previously under the very narrow definition that it was financial gain for shareholders. I think while this was somewhat myopic in a sense, but it worked at the time, and with competition increasing, with competition coming out of every left, right, and whichever way you can think about from across the world becoming a global village, I think this view has had to change. Value, as it currently exists, also encompasses how well an organization performs from a social point of view. How does it interact with society? How does an organization impact the environment in which it operates? Will this organization, given these two factors that we've just been through, will this organization be able to survive in the long term? So is there sustainability to its business practices? Or should this organization be thinking about closing shop and maybe shareholders invest their money elsewhere? It's those sort of things that are in the back of people's minds as they're looking at an organization. How am I going to benefit from this organization? I may not be a shareholder in this organization, but ultimately, how does this organization's existence affect my existence? How does it affect the existence of everybody else around me? And it's that sort of information that is effectively coming out in the reporting that an organization will then undertake. I mentioned that corporate social responsibility has in itself become a business opportunity. There is a requirement, a need, for an organization to consider the long-term issues that affect it if that organization is to operate in an economically viable manner. And when we talk about operating in an economically viable manner, we're looking at not only the long term, but we're also looking at the current. From a strategic point of view, as a director of an organization, it should give me an opportunity to identify new business opportunities that we can then build in the long term in order to create sustainability for this organization. As a board, we then need to link all of this to the strategy that we've got for the company. In setting that strategy, we need to be aware of the impact that whatever we're doing, whatever we're setting out to achieve as an organization will have on the community at large. We also need to have a look to see how we can then counter any negative impact that whatever decisions we're taking may have on our stakeholders, and at the same time making sure that we can maximize on any positives that might exist. The business case for being a corporate, socially responsible corporate citizen is pretty clear. we should be able to walk away with improved operational efficiencies. We should be able to provide our staff with better prospects for the future. There should be increased organizational effectiveness. We should be able to manage the risk that we're faced with as an organization. It should enable us to have access to improved capital, because people are seeing that we are on the ball in terms of what is happening around us and our reaction, how we respond to things that are changing around us, in order to be able to take advantage of those situations. And advantage in this scenario is said in a nice way. In talking to our stakeholders, we should be able to have better stakeholder relationships. We should be able to preserve our license to operate. And again, a lot of governments around the world, they will give licenses to operate to organizations that they see as being socially responsible, organizations that do give back. And I think the one big thing that comes out of all of this is that as an organization, I should be able to build my brand, build my reputation, improve my competitiveness, be able to differentiate myself from my competitor. And all of this ultimately facilitates revenue generation. All of this ultimately facilitates an extension to the life that is within my organization. There have been blunders in the past. I think that goes without saying. Whether you look at Union Carbide with the Bhopal issue from 1984, with explosions back in India, or you look at Enron and the collapse in the early 2000s, Arthur Andersen's demise, British Airways and their handling of the opening of Terminal 5 some years ago, SAB Miller and the issues that they had at some point with opening breweries in water-scarce places, people like Pioneer Foods and their involvement in price fixing. All of these, so there have been areas that have occurred in the past that we can look to and we can try and learn from, in terms of the impact that these things have had on reporting overall, and how these events have had on the relationships that these organizations have then gone on to have with their various publics, with their stakeholders. In some instances, some companies went under altogether, as in the case of Union Carbide. A few years after the Bhopal incident, Union Carbide went into liquidation. You look at people like British Petroleum, they're still licking their wounds from the oil spills that have occurred over the years. And there's other people like British Airways who've been able to put themselves back on track, and Nike who've been able to put themselves back on track despite what happened in the past. But all of this would require some concerted effort by management, by the organization, to make sure that the issues that occur are dealt with, that the concerns that are raised by stakeholders are addressed. Now, if you have a look to see where integrated reporting has come from, you'll find that it's got its basis in integrated thinking. I'll go through in the next couple of slides through what integrated thinking is all about, just to give you a sense as to the sort of issues that need to be considered when it comes to integrated reporting. Integrated thinking is defined as the proactive consideration by an organization of the various relationships that it has between the various operating and functional units of the organization and the capitals that that entity uses, or the capitals that that entity affects. As an organization that has got staff members, my staff are going to be part of my capital. The money that the shareholders have put in to fund the organization are going to be part of my capital. The funding that has been provided by external financiers will be for part of my capital. So in looking at all these various capitals that I may have, and I haven't spoken through all the capitals at this stage, but in looking at these three capitals that I've just spoken about, one capital will need to be employed in order to build up another. And that capital, once built up, may then also be used to build up the capital that was used in order to build it up. So it's that sort of thing that we're saying must result all of this, in order for all of this to work nicely, to work as it should. There must be decision making that is being undertaken within the organization that considers the organization's ability to create value over the short, medium, and long term. So whatever actions an organization is undertaking, will they lead to an ability to be able to build up those capitals? So like we said before, it's not only about, is the organization able to generate a profit for the benefit of stakeholders? That organization must also be able to generate enough money, enough profit to be able to pay back the loans, and interest on what it has borrowed. It must also be in a position where it can plow back money into its staff in order to build them up. And in building up staff, whether it be through training, through giving them opportunities for personal growth, the company will not necessarily always benefit directly. But ultimately, what the organization is looking to do is build a better society around it. Now, in looking at integrated thinking forms quite a big part of King 4, the corporate governance code, and you'll find that there'll be linkages to other corporate governance codes around the world as well. Now, specifically, King 4, in talking about integrated thinking, also requires that an organization view itself as an integral part of the society in which it exists, and that it be a responsible corporate citizen. Also requires an organization to think long-term, so think sustainable development. How is that organization going to affect the economic standing of itself, of the community? How does that organization affect the environment in which it is operating? Now, all of these outcomes coming out of this thinking will affect what activities an organization undertakes, and will also have a direct influence on the 6 capitals that an organization effectively maintains, and it also has an impact on the approach that an organization uses in order to engage with its stakeholders. In looking at what we have in the old version of the King Code of Corporate Governance, it defined integrated reporting as a holistic and integrated representation of the company's performance in terms of both its financial performance and its sustainability. Now, this definition has been built upon since then, and looking at the definition that is contained in King 4, King 4 defines integrated reporting as a process that is founded on integrated thinking that results in a periodic integrated report by an organization about its value creation over time, and any related communications regarding aspects of value creation. So again, going back to that whole concept of accountability, is that as an organization goes down this particular path, it needs to be able to go back to its publics, its stakeholders, to be able to say, this is what we have done, this is why we have done it, this is the benefit, this is the benefit that is coming out of it, these are the shortcomings that we have as an organization that we need to address going forward, and this is how we will address it. The one thing about integrated reporting that we need to be clear about is that it isn't a marketing document. It's a document that comes out of introspection of an organization, looking at itself, looking at what it's been able to achieve, look at what it's planning on doing, and going back to the stakeholders to say, we've listened to what you said to us, and this is how we're going to address the particular concerns that you have. We have some guidance that is currently available on integrated reporting. We have the Integrated Reporting Committee of South Africa's document that was issued back in 2011. We also have the International Integrated Reporting Committee's framework document that was issued back in December of 2013. The South Africa document, while it has not been retracted, is not in as much use any longer. The South Africa Committee made a recommendation back in 2014 that the international document be used. So at this point in time, the bulk of the people that are reporting on this document in that part of the world will apply the international document. Looking at the integrated report itself, its primary purpose is to provide a concise communication about how an entity's strategy, how its governance, its performance, and its prospects will lead to its ability to create value in the short, medium, and long term. If you look at the moment at the way that reporting has gone, specifically around financial reporting, IFRS has over the years become quite complicated in a lot of instances, and while there's a thrust at the moment to try and reduce the complexity, we also find ourselves living in an environment where people are bombarded with so much information all the time that in order to catch people's attention, you need to be able to have a value proposition to them that makes sense. And that value proposition at this point in time may include some brevity. This is when integrated report comes into play. An integrated report then takes into consideration some financial information as well as other information around how an organization is performing, and presents this information to employees, to customers, to suppliers, to an organization's business partners, the society around it, regulators, policymakers, in a way that they can understand without necessarily having to be schooled in financial reporting standards. What does it seek to achieve? Integrated reporting is seeking to achieve the creation of a single report that will be the entity's primary report. There was concern that smaller listed companies would struggle to produce an integrated report. Folks, whether you're a small company, big company, I think everybody will go through a process of learning, of trying to understand what should be in this report and what should not. So what the framework has done, it has tried to be very principles based, tried not to be prescriptive in terms of what should be included in the report. And what I think we will see is an improvement of the application of the framework over a period of time. In the short term, yes, we might have issues around comparability, issues for investors as they try to compare one report against another. But I think in the long term, as we've seen with financial reporting, I think things will will find a balance. spend a little bit of time now just talking about the relationship between integrated reporting and sustainability reporting. Sustainability reporting has been around for a lot longer than integrated reporting has, and it's a process that assists entities in setting goals and measuring their performance, and it gives them an ability to manage any change that they may need to go through. And in talking about managing change, we live in a world that is changing. And in order to create an organization that is able to adapt to these changes, one needs to have a bird's eye view of what's going on. One needs to have a bird's eye view of what's going on within one's organization. One needs to have one finger on the profitability pulse. One needs to have another finger on the social responsibility pulse, and also have a look to see what impact the organization has on the environment. Now, all these things take quite a bit of planning in order to be able to achieve them appropriately. So what sustainability reporting effectively then does is that it creates this platform for communicating what an organization is doing around all these things. And it also enables an organization to hold up a mirror to itself to say, look, this is what we said we were going to do. Have we been able to achieve it? And in looking at all of this, what the sustainability reporting enabled an organization to do is, apart from holding up a mirror to see how well it is doing, it also required an organization to talk to its stakeholders, to determine what their expectations are, what their interests are, what is it that drives their interactions with the organization. And all of this should ultimately, if taken into consideration appropriately, result in an organization that is sustainable in the long term. Integrated reporting, on the other hand, is an emerging and evolving trend in corporate reporting, which aims primarily to offer an entity's providers of financial capital with an integrated representation of the key factors that are material to its present and future value creation. So brevity comes into play here. It builds on the principles that have already been put in place by sustainability reporting. Some of the disclosures you'll find are similar, but it may not necessarily go to the same extent as sustainability reporting would require. Like we said, it's a concise representation of how an organization's strategy, its governance, and its performance, and its prospects lead to the creation of value over a period of time. It is not intended to be an extract of the annual report. It's not intended to be a combination of the annual report and a sustainability report. The intention is provide information, snapshot, that explains to the reader who the organization is, what the organization is all about, and what it is that makes this organization function. Sustainability reporting itself is an element of integrated reporting, and an intrinsic element at that, in that there are a lot of principles that sustainability reporting talks to that are carried forward into an integrated report. Issues around determining things that are material. What are the sustainability priorities? What are the key topics that an organization should be focusing on? What are the key issues that are going to affect an organization's sustainability in the long term? What risks exist? What opportunities exist? And all of these matters you'll find are a key input into how those charged with governance within an organization will manage the organization, how they report on what they deem to be material issues, how they determine what is a strategic objective, and how they determine where an organization is going to go. Now, all of this must come through in the integrated report, because as a stakeholder looking in, for me to be able to buy into what an organization is selling me, the story that the organization is selling me, I must be in a position where I understand what the organization stands for. This leads us into the stock and flow of capitals. When you're talking about capitals, these are the stores of value that an organization has got that increase or decrease as an organization progresses, and will be transformed through the activities that an organization undertakes. Like I said previously, is that as an organization, I might decide that I'm going to take out of my capital, my financial capital, in order to spend money on training of my human capital. So in the short term, I've got less money available to me, but I've got a better skilled workforce that hopefully tomorrow will be in a position to take advantage of opportunities that come the organization's way. They can better identify them, and all of this you'll find that will determine whether or not my organization is a success or a failure. So there is an interrelationship between the various capitals, and there'll always be a constant flow between them as well. Might not always be flattering in terms of how it progresses, that we might make losses in the 1 year from a financial capital point of view, but hopefully at some point those losses may be recouped. There are effectively 6 categories of capitals that an organization has access to. These 6 categories of capitals are financial, manufactured capital, intellectual capital, human capital, social and relationship, and natural capitals. I'll go through them one by one, just to elaborate a little bit on what each one of them stands for. Financial capital, as we all appreciate, is the pool of funds that is available to an organization for use in the production of goods or the provision of services to its customers, and it's obtained through raising of debt, through raising of equity. It might be grants that are given by governments, or it might be money that is generated through the operations or investments that are made by this organization. Effectively, we're looking at profits that are made by an organization in that last one. Now, this differs from manufactured capital. Manufactured capital are physical objects that are available for use in the production of goods or the provision of services. So here we're looking at things that are made. There might be buildings, might be equipment, it might be infrastructure that has been put in place. Now that differs from intellectual capital, which is effectively knowledge-based, intangible assets that an organization might have access to. So I'm looking here at intellectual property. So I might have a copyright, I might have registered a patent, I might have developed software that I use within my organization. I might have a license to mine in a particular area. All of these things would be my intellectual capital. But it doesn't stop there. It could be organizational capital as well. Things that I don't necessarily have on my balance sheet. Tacit knowledge of the way that things work. How to go about undertaking business in a particular part of the world. Putting in place systems that enable my organization to function more efficiently. Putting in place procedures and protocols that will enable me to have an advantage over my competitors. All those things would form part of my organization's intellectual capital. Human capital would be my people, their competencies, their capabilities and experience, the things that motivate them to go that extra mile. to go and innovate in order to keep the organization ahead of the curve. Now, in looking at my human capital, whatever my labor force do must be aligned with and support the organization's thinking. That's not to say that whatever the organization is planning on doing should be foisted down their throats, but there must be some consensus that is arrived at between management and staff in terms of which way the organization is going. It also talks to the ability by an organization, by those charged with governance within an organization, to develop and implement the organization's strategy, taking into consideration their consultations with staff, with other stakeholders, and making sure that there's a marriage between the various parties' thinking. This will ultimately lead to loyalty, will motivate people to do better for the organization. Let's not forget that we also have a social responsibility, those relationships with people outside of the organization that must also be nurtured. It's about determining what shared norms exist. What are the common values that the organization has with its stakeholders? Determining which are the key stakeholder relationships that must be built up. Where must trust be earned? And all of this comes out of an ability to talk to these stakeholders, identifying who they are, talking to these stakeholders, listen to what they've got to say, and taking it on board in terms of determining what the organization's strategy is. Effectively, what we're looking at is the thing that gives an organization its license to operate. If people disagree with what an organization stands for, they could lobby stakeholders, they could lobby policymakers to legislate that organization out of business. So it's that sort of thing that we're saying, well, an organization must be fully aware of what's going on around it in order for it to carry on operating. Then we have the natural capitals. Here we look at all the renewable and non-renewable resources that an organization has got access to. The processes that it follows in order to bring all these things together in order to be able to generate value for its stakeholders. Now, all these capitals must be brought together in a process that we call the value creation process. The value creation process effectively then links all these various things, like we said, to take from one, give to another. But the business model in which the organization is operating, that business model will effectively then enable the organization to take the 6 capitals, coming in the one end, going out the other, hopefully having an enhanced sum or all of the capitals. If we're able to achieve that, then that's effectively the value creation process that we're talking about. Doesn't always work that it's what comes out the other end is greater than what went in the other. But again, an organization must prioritize the various things that it's working towards, and coming out of that then determines which way an organization progresses. There is a link in all of this to corporate governance, in that an organization must therefore make sure that in allocating, in prioritizing what work it's going to be doing, that it takes into consideration the various issues that it is faced with, rank those issues based on what's most important to what's least important, and then put together a strategy, a plan that it'll put into play that will enable it to then meet the outcomes that its stakeholders require of it. There are 2 principles that are being addressed in doing all of this. The governing body of the organization should appreciate that there will be risks and opportunities that it'll face, and that the entity's core purpose, its strategy, its business model, its performance and sustainable development that it's seeking to achieve, all of these things are inseparable elements of the value creation process. Secondly, the governing body is also saying, well, while we've identified all these things that we're saying we're going to prioritize, well, we need to go back and report back to our stakeholders so that they are informed about where we're going, how we have performed, and to the extent that we have not done well, we tell them that we have not done well. To the extent that we've done fantastically, we explain that too. Now, all of that comes out in my comes from my integrated report. So, what should be in your integrated report when you put it all together? As I said previously, an integrated report is drafted based on a framework that is principles-based. The intention of the principles-based approach is to strike an appropriate balance between flexibility and prescription. It's not about telling an organization you will make sure that this is included in your report, but it's to give guidance in terms of the sort of matters that one might consider for inclusion in that report. So the framework itself does not prescribe specific key performance indicators that an organization should work towards. Neither does it prescribe measurement methods or disclosures that must be made. But it simply says to an organization, consider which matters are material. Once you've done that, you go ahead and determine how you will disclose those matters. And in doing all of that, there'll obviously be some generally accepted measurement methods that might crop up. Disclose those to us so we understand, as people that are reading your reports, the basis on which this report has been put together. The framework that is applied also does, while it identifies the information that will be included in an integrated report, it does not set the benchmarks that an organization should follow in terms of what its performance is going to be, how its performance is going to be rated. And it is also written primarily with the intention of it being used in the private sector, or by for-profit organizations, but, and this is a big but, any organization can use it. Any company of any size. Non-profit organizations can also use it. Public sector organizations can also use the reporting principles. So there's no limitation. So yes, the wording that is used implies that there's a limitation, but it's not actually the intention here. We're going to look at the guiding principles next. The guiding principles that are applied are contained in section 3 of the framework. And these are applied individually, collectively, with the intention of preparing a report. And you'll find that in a lot of cases there may be judgment that is required when one applies them. For example, as I've got in the slide in front of you, sometimes there might be a tension between trying to keep a report as brief as possible, but at the same time striving to make sure that it's as complete as possible. So a preparer of such a report would need to make a call in terms of what they deem to be important. And again, one of the guiding principles behind the standard is it must talk to things that are material. So let's move on with this. Let's talk about the various things that are in the guiding principles section. The framework says that the report must have a strategic focus and a future orientation. So it must provide some insight as to where the organization is going, what its strategy is. Will it be able to create, or how it will be able to create value in the future? And the value that we're looking at here is not only now, it's the medium term, it's the long term. And how does an organization employ the 6 capitals that it has access to in this process of value creation? The information we're providing in the report must provide a holistic picture of the organization, the interrelatedness of the various factors that influence which way the organization is going, and how those factors will influence the organization's ability to create value over time. It must also address stakeholder relationships, providing insight into the nature and the quality of an organization's relationships with its key stakeholders. Who are these people? How have they been identified? To what extent are they consulted by the organization? To what extent has the organization taken into consideration their legitimate needs and their interests? It also must look at things that are material. It's not about including anything and everything in the report. It's about those matters that have a substantive impact on the organization's ability to create value. The report must also be concise. We've spoken about completeness, must be reliable, and it must allow some sort of consistency of reporting, must allow comparability. Then that way, when I pick up one report and compare it against the previous years, well, you can see where there's improvement, where the organization is going. And when you compare one organization against the next, again, there must be some ability there to then be able to work out which way things are going for that particular organization. So in looking at what sort of information would be included in the report, the International Integrated Reporting Committee's framework requires that the organization set out very clearly the scope and the boundary of the report that is being prepared. So what's included, what organization does it relate to? If the group of companies, for instance, has got subsidiary companies, has got associate companies, has got joint arrangements that it has entered into, all those companies included in the reporting that is being provided. All of that must be clear. It must give an organizational overview and talk to the business model of the organization, what the organization does. It must talk to governance and remuneration of the organization as well. How is the board structured? How was staff? How are the members of the board of directors? How are they remunerated? What are the risks and opportunities that exist for this organization? Any strategic objectives and strategies that have been employed in order to reach those objectives? How well has the organization performed? And in coming back to that future orientation aspect of it, what are the opportunities, the challenges, the uncertainties that an organization faces, and how do all of these things correlate with the strategic objectives that the organization has got? And does the leadership of this organization think that they'll be able to take this organization forward? So there must be some analytical commentary as well that goes hand in hand with it. There are a few content elements that have also been included in here to give us some guidance as to the sort of content that the report should have, the sort of things that we should take into consideration in writing the report. These are contained in section 4 of the framework, and there's 8 content elements in total. And effectively what it is questions that we must ask of ourselves as we're preparing the report. From an organizational overview and external environment point of view, what does the organization do, and what are the circumstances under which it operates? That must be included in there. How does the organization's governance structure support its ability to create value in the long term, in the short term, in the medium term as well? What does the organization actually do? So its inputs, its business activities, the outputs, the outcomes that it's striving to achieve. Does it have multiple business models? Again, talk to all these things. What are the risks and the opportunities that an organization faces? How will those risks and opportunities affect the organization's ability to create value over the short, medium, and long term? And how is this organization responding to changes in these areas? Moving on to the fifth one, where does the organization want to go? What resources will it need? Is it allocating resources in the right places? How will it get to where it intends to go? How has the organization performed? So to what extent has the organization achieved what it set out to achieve? Again, all of that must come into the disclosures. And this, coupled with disclosure around the outlook for the organization. What challenges, what uncertainties lie ahead of the organization? And how will management address these things? The last one is pretty mundane, pretty straightforward. The basis of presentation. How does the organization determine what matters are included in the report? So what is material and what isn't? The reporting boundaries. The significant frameworks and methods that have been employed in putting this report together. The framework does provide some guidance, some additional guidance on determining what is material, determining the capitals, the time frames, what should be aggregated and what should be disaggregated, that sort of information. Again, just to give us a sense as to what we should take into consideration in crafting the report. Now that we've crafted the report, it's also around the reliability of that particular report. So how reliable is the integrated report that we've put together? An integrated report should include a statement from those that are charged with governance that acknowledges their responsibility for the preparation of the report, that says that they've applied their collective mind in the preparation of the report, and that in their opinion, the report provides a decent view of what's going on within the organization, and that the report itself has been prepared in accordance with what is provided for in the framework. Now, in including all this information in the report, an organization can choose to have the report assured, externally assured, or it could decide to have the report assured internally. Now, different corporate governance frameworks out there have got different requirements. I'm going to look specifically at what the King 3 requirements are at the moment, and there they propose what is called a combined assurance model, that management must get involved. There must be internal assurance providers who also get involved in looking at the report. I'm looking at internal audit there, and external assurance providers as well, where you can afford to bring them in. Now, in looking at all three assurance providers, management coming in and saying, look, the information we're providing is to the best of our knowledge true about this. The internal assurance providers coming in and checking that the systems actually work as they should, and external assurance providers also coming in and having a look to see when they, based on their understanding of the organization and the risks that the organization is faced with, does the report provide an apt view of where the organization is? All of this are methods that one can employ. It could be one of them, it could be all three of them, it could be two of them. There isn't prescription in terms of which way one goes when it comes to this. We spoke about the frameworks that are that can be used in preparation of the report. It's not just the International Integrated Reporting Framework that one can apply. You can also have a look at other standards that may be applicable to you. For instance, if you happen to be in the fisheries business, you might look at the Marine Stewardship Council standards. If you're a forestry business, the Forest Stewardship Council business, there's a lot of businesses that have adopted the ISO standards on quality control. There's some businesses in the tourism space, for instance, that have adopted the Sigma standards for quality control within their environments. So any one of these can also be applied in addition to what is sitting in the International Integrated Reporting Framework without any problems at all. Now, why are we reporting? Why is this important? We've had a significant shift in the market. There's a significant growth in socially responsible investment, and companies who want to see that what they do, where they're putting their money, investors who are saying where they're putting their money is in a business that takes into consideration what is going on around it. There's a significant amount of increase in consumer awareness of climate change issues. Again, as an organization that is operating in an environment where it's affecting this, are we being regulated out of business? Are we reacting to what's going on? And in doing that, creating new opportunities that will enable us to carry on long into the future. Growing need for environmental and social risk management. Again, with the legislation that is coming our way, as an organization, it's a risk, it's a threat, and that must be addressed. And in addressing it, it's not about lobbying, it's also about, can we change the business in a way that enables the business to be able to adapt to changing requirements in the market. There's a great market for ethical goods and services, corporate responsibility trends, changes in legislation I've spoken about, the evidence of the increased role that corporate social responsibility plays when it comes to staff retention and attraction. And never mind the increased shareholder activism that seems to be coming our way at this point in time. The pressure for organizations to do what is right. And it should not be pressure. If anything, this should say, this is an opportunity for the organization to do the right thing. That in a nutshell is what integrated reporting is all about. So these are the various issues that we covered in today's session. Thank you very much.